All right, welcome to the Explainer. Today, we're diving into something pretty wild. It's a financial theory from our source material that suggests there's this hidden layer to our tax system, one that almost nobody knows about.
So look at this number, just over $1,000,000. On its own, okay, it's a big number. But where this money supposedly comes from? Now that's the part that gets really interesting.
Our source material claims this was a tax refund, a refund for someone who only deposited $96,000. You do the math on that, that's like a 10x return, pulled, they say, directly from the tax system. So that's the big question, right? How could that possibly work? A 10x return from a tax refund. Well, that's what we're here to do. We're going to break down exactly how this theory supposedly works piece by piece. Okay, so the first clue in this whole mystery, according to the strategy, boils down to two different IRS forms. You've got the one pretty much everyone uses, and then you got this other one that most of us have probably never even seen.
And this right here, this is really the core idea. On one side, you have the Form 1040. The source material calls this the handcuffs, right? It ties you to your Social Security number, and it supposedly puts you in the position of a debtor. But then, over on the right, you have Form 1041, which is for trusts, and they call that the key. The idea is it lets a private entity act as a creditor and, get this, supposedly get back all the funds it deposited.
So you see, the big claim here is that it's not just about which box you check on your taxes. The theory says this is about a complete change in your financial identity. You're shifting from being a debtor, someone who owes, to being a creditor, an entity that is owed. So becoming the creditor, what does that actually mean? How do you do it? Well, the whole strategy is built around one very specific legal tool. And that's the trust. Now, the person who files that Form 1041 is called a fiduciary. And this is a really key concept in the theory. See, the fiduciary is acting for the trust, not for themselves. This creates this legal wall of separation. The trust is its own thing, totally separate from the person managing it. And if you operate this way, the source material says you unlock some pretty incredible benefits. I mean, the biggest one, the most out there claim, is that you can get back 100% of the money the trust deposits in a bank. But it also talks about things like protecting your assets, more financial privacy, and even offsetting other taxes. Okay, I know what you're thinking. A 10x return? Where on earth is a bank getting that kind of money to give back? Well, according to this theory, the answer is hidden in the very way modern banks work. So this part of the strategy actually leans on a legitimate economic concept called modern money mechanics. It was even described in a publication from the Federal Reserve. And the core idea is simple but powerful. Banks don't just hold on to your money. They use your deposits to create brand new money by making loans. This is what's known as the money multiplier effect, or fractional reserve banking. Let's walk through it. Say a trust deposits $100. The bank only has to keep a tiny bit of that, maybe $10. It then lends out the other $90. But here's the magic trick. That $90 loan gets deposited somewhere else, and that bank then lends out a chunk of it. The cycle just keeps going, turning that original $100 into $900 or even more of new money flowing through the economy. And this brings us to the absolute linchpin of the whole theory. The source argues, but the true value isn't your $100 deposit. No. The real value is the power your deposit gives the bank to create $1,000. And the theory says that value, that's something you can monetize. That's what a creditor trust can supposedly go and claim. Okay, so we've got our players, right? The trust and the bank, and we've got the mechanism, money creation. Now let's get down to the nuts and bolts. What's the actual paperwork trail they claim you used to pull this off? So this whole thing apparently comes down to using 3 specific IRS forms, but in a very unconventional way. You've got the 1099-A and the 1099 OID to make the claim, and then the Form 1041 is where it all comes together. Let's break down what each one supposedly does. All right, step 1, Form 1099-A. Now, this form is normally for stuff like a car being repossessed. But in this strategy, they completely repurpose it. It's used to claim the fair market value of your deposit. Not what you put in, but that huge leveraged amount the bank created with it. They treat it like you're getting your main asset back. Okay, next up is Form 1099 OID. Usually this is for interest you get from bonds or something, but here the theory says you use it to claim the profit the bank made from using your money. So that's the second piece of your supposed return.
So let's put some numbers on this, like in our sources example. That initial deposit could be leveraged into a huge $1 million principal claim using the 1099-A. And on top of that, you'd claim another, say, $80,000 in profit or interest using the 1099 OID.
But wait a second. $1 million return? Wouldn't that come with an absolutely massive tax bill? And this is the final crucial twist in the theory. They claim you can report all this on the Form 1041 without actually creating any tax liability. So here's how they say it's done. That huge $1 million principal from the 1099-A, they argue it's a return of capital. Basically, you're just getting your own asset back, so it's not taxable. That just leaves the $80,000 in interest as income. But then the trust turns around and claims an equal amount in deductions for things like fiduciary fees. And just like that, boom, the final tax bill is $0. So let's just recap the whole thing real quick. 1, you create a trust to act as a creditor. 2, you deposit money, which the bank then leverages like crazy. 3, you use a Form 1099-A to claim that full leveraged value back. 4, you use a 1099 OID to claim the profit the bank made. And 5, you report it all on a Form 1041 and use deductions to wipe out the tax bill. That's the strategy in a nutshell. And that's the theory. Our source material lays this out as a kind of secret key, a way to unlock this incredible value from the financial system. So the question we're left with is, well, it's a big one. Is this some kind of hidden financial truth, or is it just a theory that's way, way too good to be true? We've laid out the pieces from the source. Now it's up to you to think about it. Thanks for joining us for this explainer.